this video, we are going to do financial decisions. Financial decisions are also called finance function or finance aspect. And this is the part 2. Now let us study what are going to be the objectives. First of all, we will understand what financial decisions are and what are its types. Then we'll study about the investment decision, the types, and the factors affecting the capital budgeting. So let's start. Financial decisions are of 3 types: investment decision, financing decision, and dividend decision. Now please remember that financing decision is one type of financial decision. The financial decision and financing are different. Sometimes students get confused between the two. So financing is a part of financial decision. Having noted that, let's move ahead. Let's start with the first type of function or decision, that is investment decision. Again, what do we do in investment decision? In investment decision, the finance manager decides where to invest and how to invest. So when he has to make some investment, he has various choices. So he sees whether he should invest in machinery or building, or should he invest the money outside. And also along with that, he decides how to invest. Now, investment decision is of 2 types: capital budgeting decision and working capital decision. Capital budgeting decision is a decision taken for the long term, and working capital decision affect the short term. Let's understand the difference between the two. Capital budgeting decision, they are called long-term investment decision, like buying machinery or building, etc. So these assets are going to last for a long time. And working capital decision, they are for short term, like for example, debtors, stock. So these decisions are for the short term. Then the capital budgeting decision, they affect the earning capacity in the long run. So today you're making the investment, but your return is going to be in the long run. You will start earning only in the long run. Whereas the working capital decision, the earning capacity increases in the short run. And capital budgeting decisions, they affect the size of profit, size of asset and profit. And whereas working capital decision, they affect the liquidity. So let's understand this with the help of an example. Now, for example, there are 2 people, A and B, and both have taken a loan of 20 lakhs from the bank for a period of 10 years. So they have to return it every year, and the interest comes to 4,000. So together they have to return 24 lakhs over a period of 10 years. That comes to 2,40,000 per year and 20,000 per month. So every month, both A and B have to return 20,000 to the bank. Now let us see what did they do, whether they invested their money profitably or not. Now what Mr. A did was, he made a house. He constructed a house with that money and he rented it out. So in the first year, the rent was 10,000, whereas his installment was 20,000. So 10,000 he was paying from his pocket to the bank. Till the 5th year, the rent was 10,000. Then after 5th year, the rent increased to 15,000, but his installment was still 20,000. So 5,000 he was still paying from his pocket. So by the 10th year, that is the year the loan got over, he had started earning 20,000 from rent. And subsequently, the rent kept on increasing. So he had increased his earning capacity in the future. He had built up a asset, and the earning capacity in the future increased, not in the current year. In the current year, he was only incurring expenditure, but in the future, he increased his earning capacity. Now let us see what Mr. B did. Now Mr. B took a long-term loan, but he used it for day-to-day expenses. He never built any asset. So he used it to run his business. Now what happened? First year, he was able to pay 20,000 per month. Till the 5th year, he could pay 20,000 per month. But by the 6th year, he had used up all the money just to run the day-to-day expenses of his business, and he had not made any asset. So what happened? He could not pay the installment. And because he could not pay the installment, the bank sold the property which he had mortgaged to raise the loan, and they recovered their money. So whatever property he had, even that he had to give to the bank. So Mr. B ended up having nothing. That is why they say that the capital budgeting decision should be taken very carefully, because it affects the earning capacity in the long run. It has huge amount of money and risk is involved. Now let us see what are the factors that the finance manager keeps in mind before he takes the capital budgeting decision. Capital budgeting decision is going to give you return only in the long run. So you really have to think about it carefully before you make the investment. The first factor he sees is the cash flow of the project. Suppose he has to invest outside the business, then he sees whether he's going to get sufficient amount of cash or not. Is the cash flow of that project sufficient? If he feels that the cash flow is very less, then he will never invest. Some projects are such that the cash flow is after a very long period of time. So therefore, the finance manager will never invest in those projects. He'll always invest in a project in which there is a continuous flow of cash throughout. Then the second factor that he keeps in mind is the rate of return. Now, whenever a finance manager is investing, making a capital budgeting decision of investment, then in that case, he will compare the rate of return of different projects. Now, the example I've taken here is that there's a project A that is giving 10% return, and there's another project B that is giving 60% return. Now, when you look at it, it looks 60% is so attractive. But remember, if the rate of return is more, then the risk will also be more. The finance manager will never go in for B, because that means that's too much of risk. There may be something wrong in it. So he will settle for project A. But suppose project A is giving 10% return and project B is giving 12% return, then the finance manager will go in for project B. And the third criteria that the finance manager keeps in mind when he's taking the capital budgeting decision is the criteria involved. How is he supposed to invest? For example, he makes calculations like the amount of investment. What is the amount of investment that is required? If the amount of investment is very huge, he may not go in for that project. Then the rate of return, the bank rate he will see. What return is he getting? What is the bank rate at that time? If the bank rate is more than the rate of return or almost the same as the rate of return that is being offered by the project, then it is much safer to put the money in the bank. All these things he keeps in mind before he makes a capital budgeting decision. And these techniques that he's using are called capital budgeting techniques. Now let's take up a case study and see whatever we've learned, will we be able to understand and answer the case study? Now, I've told you earlier also, when you're doing the case study, you must always first read what is asked, and then from that point of view, we're going to start reading the case study. So here it says, identify and explain the financial decision to be taken by Radha and explain any two factors affecting it. So let us see which decision are they talking about. And this question came in CBSE 2017 compartment. So Radha is an enterprising businesswoman who has been running a fishery for the past 10 years. She has invested 10 lakh from her business. She shared with the family a desire to utilize this money to expand her business. Her family members gave her different suggestions like buying new machinery to replace the existing one, acquiring altogether new equipment with latest technology, opening a new branch of the fishery in another village, and so on. Since these decisions are crucial for a business, huge amount of money and are irreversible except at a huge cost, Radha wants to analyze all aspects of the decision before taking any step. So have you been able to guess what the answer is? Okay, let me share it with you. Yes, you guessed it right. So here the other keywords: expand her business. So for that, she's buying machinery. So this is capital budgeting decision, investment decision, replace an existing machine or buy a new machine, and huge amount, irreversible. These are all hinting at capital budgeting decision. So once you know it's a capital budgeting decision, you will automatically know the factors affecting it. So here the decision is investment decision, that is capital budgeting decision. Children, please don't just write investment decision, because investment decision itself are of two types. So you must specify that it is a capital budgeting decision, and the two factors affecting are the cash flow and the rate of return of the project. That's it in this video, children.